Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing in that specific order. Today is Monday, December 16th, 2024. Today's episode starts with Macro Daily Reminder Monday with a huge update. And that update is 3-month, 10-year yield curve reversion. The Central Bank of the United States, the Federal Reserve, has the ability to raise rates in the overnight borrowing to the point where it's a very attractive place to be. It's the highest rate of return for who knows how long. When they do that, it's restricting the economy. It's getting investors, people to try to save money in order to help slow down the economy. When this occurs at a strong degree, you end up with an inverted yield curve. And the most important part of this yield curve is the difference between what you can get for return on a 10-year Treasury note versus a 3-month Treasury bill. When this is negative, it suggests that the Federal Reserve is in a very restrictive mode, that they are purposefully making it very attractive to basically not invest money, not spend money, to save money and get a higher return from that, and also make it harder for companies to borrow money, making, business slow down on that end as well. And as you can see, starting in October of 2022, we have been inverted for over 2 years. And on Friday, December the 13th, Friday the 13th, guys, Friday the 13th, we had reversion. Unreal. After a solid more than 2-year inversion of the 10-year minus 3-month Treasury yield. Scrolling out to a larger view of this current chart, if you go on the max on the Fred website, this dates back to the 80s. Every time that we invert and then we uninvert, we get to the point where the Fed is actually saying, we're done trying to slow the economy down because we see things about to slow down. And they're right every time, because as soon as we uninvert or revert, we go into the gray bar, which is the recession happening beginning in 1990 for that recession there. We inverted, looks like July of 2000 and just 2000, sorry. And then soon as we uninvert, this was beginning of 2001, going into the dot-com bust, major recession. Again, before the great financial crisis. We invert in 2006, the Fed purposefully slowing down the economy. We revert in May of 2007, and then within 5 months, we are clearly in the financial crisis, the biggest recession that we've had in a long time, in 2007. And people don't realize it, but even before COVID, we actually had an inversion and a reversion before that little mini recession where we slammed rates to zero and turned on the money printer like nobody's business and, came out of it. And then here we go again. And just look at how deep this was inverted and for how long. We haven't, for the past many decades, we have not seen inversion this deep or this long, suggesting that these recession bars here may look like child's play when we look at what's coming. But that's just me and my crystal ball. Now, theoretically, you can have something called a bear steepening reversion, where the Fed basically keeps rates steady and the market realizes that the economy is hot and heating up so much that the longer rates actually rise above the shorter rates. And that's not what's occurring. We're in the cutting cycle. We're about to cut another 25 basis points with a total of 100 basis points, I guess we call it. so far in this cutting cycle. The 3-month treasury has been dropping like a stone, like it does in a bull steepening scenario. And when you have bull steepening reversion, that's it. This is it. The recession starts now, Friday the 13th, December 2024. And there it is. And so that's my new update on the daily reminders. I had before here 2-year, 10-year, talking about the inversion and the reversion, but this is much more significant, which updates the crystal ball reading again to going back to a much stronger crystal ball reading of major recession or depression absolutely imminent. I mean, within the next, maximum the next 5 months, the economy is going to come to a screeching halt. For people that believe the Fed is cutting too early, the 10-year break-even inflation rate has been stuck between 2 and 2.6%. This market is the proof that the market is not seeing further worse inflation. They're seeing inflation, it's being priced right now as being pretty tame and has been priced that way for more than 2 years. So the likelihood of the long end of the curve to go up in the face of more inflation because of a few Fed cuts, which, by the way, are less effective because of the amount of fiscal debt that we have right now. When you have fiscal dominance or more fiscal dominance than you had before, monetary policy is less effective. Just like when they were hiking rates and they were surprised that the fact that inflation kept going, beyond their control, like what's happening, they had to keep raising. Everyone was stunned by this. It has to do with the fact that there was so much fiscal debt. And now that we're at the cutting cycle, the cuts will equally not get the economy going as quickly as everyone expects. Additionally, the SOM rule was triggered in July of 2024. This metric says that we're already in a recession, even though the unemployment rate is only at 4.2%. This it went up. It's going up. It's curving up, and this is when it starts. And we're here now, with a 3-month, 10-year reversion. A huge, huge update. Add to this the S&P 500 being extremely expensive with a PE ratio of 31. There are many times in the past 150 years where the entire stock market was in a position where you could pay $6 for companies that make $1 a year. $6 equals $1 of return. Right now, you have to pay $31 for $1 of return. That's extremely expensive. And when you iron it out a little bit and use the CAPE ratio, it looks even worse. The CAPE ratio, also known as the Shiller PE ratio, is based on an average inflation-adjusted earnings from the previous 10 years. And as you can see from this chart dating back 150 years, before the Great Depression, it was obvious to the Shiller ratio that valuations were absolutely out of control in 1929 at 31.5. This is when people were feeling very comfortable about their stock positions and saying, well, everyone's going to be rich forever. It's just going to keep going up in price, without realizing that there's something called value, and that can differ from the price. And what happened? We had no returns for about 30 years, maybe even 35 years, considering the rate of inflation. And today, even, sometimes this can spike up because of earnings contraction. If all of a sudden companies can't make any money, then the price relative to the money that they make seems really expensive. And we don't have that right now. Instead, the price has just gone way up. And we're sitting at a CAPE Shiller ratio right now of 39. This is historically expensive. Sometimes this can go as low as 7. And right now it is at 39. This is not a small deal. This is a very big deal. This indicates that we have the potential to see no returns in the stock market for the next 30 to 40 years. And I'm not exaggerating. And I'm not making this stuff up. it's really not actually even that hard to understand. And it's very frustrating looking out there in the world and seeing how people really just, they're not going to get it. They're not going to get it until after the fact. And it's a little upsetting, to be honest. But we're headed into some really bad stuff. Very expensive stocks can sometimes make sense if treasury yields are extremely low. If the return you can get on a guaranteed security is like nothing, then the price of the stock market could be anywhere. But when you have a guaranteed return, with a 30-year treasury now being over 4.5%, and all treasury yields being above 4%, this is screaming that there's a huge mismatch between the value of stocks and bonds right now. Bonds being massively undervalued relative to the price of stocks at this moment. I put this TNX pattern in here. This is less relevant than everything else here, but I think I did want to include it just so I don't have to repeat it on my daily shows. TNX is the 10-year Treasury note yield. Very notably, this is just a chart pattern. And remember, this is number 3 on the list of what's important to me. This isn't one of the main drivers of my macro views, but I believe it is nonetheless significant. We had a peak in the 10-year Treasury note yield in March of 2021. And if you connect it to these two bottoms, you have a head and shoulders top on yields, which broke in July of 2024, recently retested up to this line. I can get rid of this wedge here now because it's less relevant. And we're still hanging out here. The target pattern from the head to the neck, when you go to the break where it broke, is 2.8% on the 10-year note yield. Notably, we will have a little bit of a battle probably around the 3.6 range because of some major parallel trend lines going on, but the ultimate target is still around 2.8%. I believe that it is probable we will go lower, and I'm not betting on that because nobody has a crystal ball. Well, I have a crystal ball. There you go. There's the pattern here. And this is why I have right now 57% of my own portfolio invested in ZROZ and TMF, which is, they're basically more sensitive to interest rates than TLT, the more popular long duration treasury bond fund. This pattern, plus my macro view of seeing the discrepancy of value between stocks and bonds right now, says that this is an amazing investment opportunity, perhaps one of a lifetime. Adding to the sad chaos of what I see going on, junk bond credit spreads are at historic tightness. When you buy a treasury security from the United States government, it's backed by the full faith and credit of the entire United States government. Sometimes people want to lend money to other people, though. And when you lend to other people, it typically has a little bit of a higher risk because you're not so sure that you're going to be paid back the full amount or even any of it. Sometimes you can lend your money and it'll just disappear. There are times where people feel very confident about the economy and don't need that much more money than you can get on a treasury yield because they're like, oh, yeah, of course you'll be able to pay me back because the economy is doing great. And there's periods where the economy is not suffering and not doing so well, and people have to say, well, it seems like a lot of risk, so I'm going to have to get a lot higher return on lending you money. Today, in December of 2024, we are at historic tightness between junk bonds, and they're called junk bonds because they're junk, because we know that some of them are going to default and go bankrupt. That's why they have to pay as much more on their debt that they do. and it's only sitting at a difference of 2.68%. Zooming out on this chart from the Fed, you can see it is very, very rare and strange to see junk bond credit spreads get below 3%. And when things really hit the fan, like in the Great Financial Crisis, they can rise as high as 20%, which means that these junk bonds are on severe discount. As it stands today, credit spreads are historically tight, as they were, notably, right before the Great Financial Crisis. Right when the market is so comfy and so confident that their neighbor's dog can easily pay them back, and, yeah, you're going to pay me 3% more than what I can get on a treasury? Of course I'll lend you, $10,000. Why not? What could possibly go wrong? The economy's going great. I'm sure you'll be able to pay me back. That's where we're at. And this is very frightening. Or exciting if you understand the severity of what's going on here. But, remember, guys, I'm just a guy with a crystal ball, right? The rate cut cycle of our central bank, the Federal Reserve, began in September with a strong 50 basis point cut, suggesting that the Fed was fearful, adding another 25 basis point cut on November, and now with almost full certainty this Wednesday, actually, they will be doing another 25 basis point cut. So now we can finally update the daily reminders. This is no longer relevant. The Fed is no longer restrictive. In fact, I would refer to the Fed as being neutral as it stands right now. And we're headed into a period where obviously they're going to be needing to go further into easing monetary policy as the economy slows down and things become more obviously falling apart, as they will do. With the daily reminders in mind, the crystal ball ratings have been slightly updated. The S&P 500 market is still currently like it's a Ponzi scheme, relying only on others to pay a higher price without the proper valuation to back it up. Very scary times. The update is that the bear market is now imminent, and I'm going to define this as maximum 5 months from now. We will by May and that's the max. It could start next month, but we're here. The 3-month 10-year has finally reverted. I've been waiting for this to happen for 2 years, and the fact that it's been inverted this long, it's very, very scary. What's coming, and like I keep saying, it's exciting if you understand the severity of what's going on here, and it's sad. It's sad that so many people are going to get they're going to get wiped out. It's my crystal ball reading that the Fed won't cut fast enough to save the economy, even if they try to get ahead of the cuts, even if they cut as fast as they possibly can. The fact that we're in a fiscal dominant situation is going to make monetary policy less effective, just like it was in Japan. It's not going to get things heating up this time as much as they think. And, with the amount of fiscal deficits that we have, the federal government is going to at least feel more restricted in their ability to spend, which will further reduce the economy's ability to keep heated. The fear of inflation is going to add to the coldness of this coming winter. The Robschild portfolio is not any kind of advice. You are responsible for your own decisions and indecisions when it comes to investing. As I already stated in this video, I'm 57% now in long duration bonds. I'm also 9% in what I consider to be very undervalued stocks in Brazil, and 13% in very undervalued stocks in China. Also 5% in Nissan stock, which, by the way, did amazingly well during the dot-com bust. If you check it out, when people feel like they have less money but still buy new cars, Nissan tends to do well in that kind of environment. And besides that, I don't even care about that part of it. I'm just looking at the balance sheet and seeing the fact that if the company were to liquidate today, I'd make an enormous amount of money. So I'm very happy to have Nissan stock. Granted, if they bleed enough money over the next year or two, it could go the other way. It's always possible for something like this to go belly up, but this is so cheap that if I'm going to follow the advice of Benjamin Graham and never have less than 25% of my portfolio in stocks, as he suggests, I got to put it somewhere. And if I'm going to put it somewhere, I'm going to put it somewhere that looks undervalued to me. And this looks like a very undervalued area, along also with rare earth metal miners, REMX. Again, this fund was in the hundreds of dollars in 2011, that long ago, and then currently only $45 a share. Highly undervalued area in the market. Before I go on, I forgot to add these EWZ, enormous dividend payment. They're paying the cash holders. They're paying the shareholders cash. They're paying them dollars. You're making real money on this. You're making more money than you make on treasuries. Plus, with inflation, I mean, this is like this. It's stupid not to be invested in Brazil right now. The way that I see it. I'm also 5% short semiconductors. Still, part of it is the overvaluation of the entire industry. I see this as essentially an industry that produces a commodity, and soon as they're making enough or too much, then the profits shrink. And the fact that there's already priced in to these companies like the profits are going to expand infinitely tells me this is like a huge bubble here. Add to that the chart pattern of huge engulfing red candles at both shoulders and a double one on the head. Suggests to me that this is very ripe for a major collapse, and I can't, Ben Graham might advise against doing what I'm doing here, but I can't resist. There's too many stars aligning right now for me not to go short here. This is just way too attractive as an opportunity. I also have 2% of my portfolio on puts. Leaps on junk bonds, HYG. Again, this has to do with the fact that credit spreads are so tight. Way to play it is to, assuming that credit spreads don't stay tight forever, because they don't. And if they were to spread enormously far apart like they did in the Great Financial Crisis, you can make an enormous amount of money with a small put position on HYG, which I have. I have 2% of my portfolio in it, and if I were to lose 2% of my portfolio for somehow being wrong, I'll survive. And then the other 3%, actually, I have just some speculative stuff, MSOS and OTGLY. I'm not even going to talk about it in this video. You can look them up and do your own homework on those. I've brought up MSOS before, and you can look into it. We will continue momentarily into more charts. Before we do so, thanks for watching, and thanks for the support. I had a mega donor drop some major support to the channel. Thank you very, very much. Really appreciate it. And yeah, for anybody else, if you enjoy my 2 cents, you can support with your 2 cents or a like, or any other way that you please. Love the comments, love everything. So moving on. Next things in the agenda, just later this week, we have obviously the FOMC meeting on Wednesday, where we're expected to have that next 25 basis point cut. We have Thursday, GDP Q3 second revision, which may be revised from that 2.9. We went from 2.8 to revised up to 2.9. It's most likely we'll stay at 2.9 or go back to 2.8 there. I don't see it as much of an event, although who knows if it gets revised much lower, that could be interesting. But anyway, then the other one is Friday, the PCE. This is the Fed favorite, PC inflation gauge, which can help guide the markets as far as what the next FOMC meeting will do as far as rates go. Last item on the agenda is the Santa Claus rally. This is a phenomenon that takes place pretty much every year. What happens is all the professionals turn off their computers, they go home, they say, you know what, I'm going to enjoy Christmas for a little bit, and they don't trade. And so what happens is retailers, the dumb money tends to just trickle into the markets, and the markets just float up nicely like the snow falling gently on your skin. And it typically happens with the last 5 trading days of December to the first 2 trading days of January. And for this year, that would be next Monday through Thursday, January 2nd of 2025. I'm not participating in this as far as a trade. I mean, you could potentially do it every year where you just, if you have cash available, just load into VU or something like that on that Monday and then just sell it on that Thursday. Like, no matter what happens, just have that be your strategy. And there's a pretty good probability apparently of that going to your favor. But I'm not going to do it because, with the 3-month 10-year reversion happening right now, if there was going to be a time where we don't get a Santa Claus rally, I think it might be this year, but I really have no idea. I said I'd go through a bunch more charts. I think we'll just leave it as Macro Monday. One other thing to add to the Macro Monday, oil. All right, so the price of oil, I've brought it up on many shows before. We've been bumping on this trend line since May of 2021, 1, 2, 3, 4, 5 times, and recently just over and hammering, and we had this wedge. I thought we'd break to the downside, instead we broke to the upside. I guess we're headed, according to Chartist, up to $73 or $74 in the short term, but just seeing this go bang, bang, bang is just another signal to me that, with oil dropping in price, you can expect disinflation, deflation. This is part of the slowing of the economy, the part of that cycle that is just like, it's just clear as day right now. It's sad and very exciting. That's the best way to put it, I'd say. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.